Where did the Brinks trade come from? I was taught that if the dealer opens the session at 3:30 and 3:45 and hits a hammer or a spike that forms the low or the high right at that time, that's almost like a deadlock reversal, like back up the Brinks truck. So it's definitely going to pay out. That's where that came from. I don't know if from other countries you have Brinks security and they handle money and like they drive the armored cars around here. So obviously you want a Brinks truck at your house. Okay, good question. How do we decide on entry when there's no second visible leg? Do we just enter past the 13 MA or just not take the trade? When you become more proficient, you can enter on, close above the 13 and all that. But you know what? You're new. I want you to take second leg trades. Second leg trades are going to give you tighter stop losses. And when the second leg presents, and you enter on the close of the second leg, the trades are going to go into profit immediately. So yes, I'm telling you, all you new guys and ones that are having trouble, stick to second leg trades. That's the way to roll. All right, what else? Okay, if the Asian range is greater than 50 to 75 pips, avoid that pair. Not much greater than 50, like 52, 53, around in there. 75 pips, if it's 75 pips or bigger, I consider that to be blown out. If you can't visibly analyze the last quarter of the box, like if you can't see it. So if you're if you have a huge blown out box, right, and you can't come in here and go, I see the consolidation right here, reanalyze the box down here, then yes, forget it, because then you would expect something like this or like this, right? If you can't visibly see this, forget it. Be loyal to the pattern, not the pair. Loyalty is to the pattern, not the pair. All right, anything else? Yep, I'm going to talk about the pivots and TDI, and that's probably going to wrap it up for tonight. Then we'll have a DMR session. And listen, for you newbies, the December recordings are up there, and I don't know how this happens, but I cover different stuff, different time, or I say stuff different. But like, I guarantee you the next class is going to be different from this class because I constantly think about what I said. I look at my own recordings, and I realize things I should say different and try to rework the slides and stuff in such a way that the class is presented better. Now, there were some rumors about me on the internet that I changed the material. And anyone that knows me from the beginning, Ray, Carr, the material is not changed. The material is the material. What I try to improve and change, and self-admittedly, and that's what they said on the internet, that self-admittedly I changed the material. No. Self-admittingly, I changed the way I present the material because I want to shorten your learning curve. I'm trying to convey what's in my head. In essence, I'm trying to dump what's in my head into your head as quickly as possible. I'm trying to take my brain and transplant it, the information that I have and that I've acquired, in such a way that you get it immediately. So it's a hard task, but I'm my own worst critic, man. I don't need some asshole on the internet calling me names and telling me my stuff's no good. I know where I'm wrong. I know I got a bad mouth. I know my flaws. I'm human. I look in the mirror too. My goal is to make everybody independent traders absent of me. Because like I told you before, my mentor died. If I was counting on him to point M's and W's, we'd all be in a shitload of trouble right now because he's not here. So after this class, I'm going to analyze what I said, what I did. I'll look at the tapes. I'll go back, rearrange the slides in such a way that maybe next time or in New Jersey it'll be better. And that's all anyone could ask for, is that I constantly try to be better, bring a better product to the table each and every time, and hopefully you build your quality of your understanding of it each time too. There are 3 market conditions that you should be able to identify. What are they? Thanks, Ken. Appreciate that. He's saying chat rooms are great, but only you're responsible for your trade. And that's a good point. Someone gets in a trade and they get jammed up. I didn't tell you to put 10 lots on a $5,000 account, 10 standards on a $5,000 account. You need to manage your money to where you can withstand a few losses without major drawdown in your account, without damage to your psyche, because you're not going to get it right, especially first. That's the beauty of the demo, man. If you can't double a demo, you got no business trading real. And I've met a lot of people that can't even double a demo. Even they say, oh, demo's no stress, more cowboy. I met people that can't do it in demo. So if you can't double a demo right out of this class, you need to go double a demo. And then put a couple $1,000 in your account and trade micros if you have to. You know the story about Casey where she had put a lot of money in the market, lost it, and wore it down, and she said, I'm not putting another dime in my account. I'm sick of it. And she said, if Steve's for real, it'll work itself out. And she took a $500 demo to over $15,000. And that's a true story, man. Kim will tell you about it, or she'll tell you about it. It's a simple answer, but there's only 3 market conditions that are real. Charles, you probably answered it. Consolidation or accumulation, right? The stop hunt, the momentum, the false move, and then the trend run. And then back into consolidation. Same thing over and over again. Okay, look. The cycle starts, consolidation, accumulation, stop hunt, trend, 3 levels, back into consolidation. Over and over again. Same stuff, different day. Okay? All right, so to break those areas down a little further, just to understand, when you see the consolidation and accumulation, what should you be doing? All right, when I see that segment of the market, I'm anticipating the stop hunt coming out of the Asian range. I'm looking for the vector, the 3 pushes. I'm looking for them to exploit the high or exploit the low or violate those levels to give me something. Okay, then all of a sudden I see it. I see the vector candle, the stop hunt. All right, now, Steve Post, that's not a trade, and that's not a trade. That is the beginning of the setup or the signal. Right? So now when I see that, I see the stop hunt, I've identified an aggressive move out of the box. What am I waiting for? I'm waiting for the confluence of events to come together. I'm waiting for a second leg, shark fin, blood in the water, TDI signals, at a pivot, moving averages crossed, the things that help me confirm that I'm in the right segment of the market, outside structure, pins to the high, pins to the low. That's what I'm looking for. And then the market goes into trend mode, and I'm looking to trade away, count the levels, and maximize my profit, or I'm going for a fixed take profit with multiple lots on because I know I've got it right and I'm in the right segment of the market. Okay? So your job is simply to identify the condition you're in and apply the appropriate action or reaction to what the dealer has done. Okay, so you walk up to a screen, the price is still in the blue box, hasn't moved much, it's about 32 pips. I'm in a consolidation accumulation. I'm going to come back around 1:30, 2 o'clock and see if he's made his aggressive move. If the structures take a long time to set up, 30 to 90 minutes up to 2 hours, you don't have to stare at the screen like a moron watching every single candle. I wasn't calling you a moron if you stare at the screen, but if he makes the first move, if you come to the chart and you see this, all right, you know that it's going to take some number of bars to do this. Right? So if you anticipate at least 4 more bars to make this pattern, take off for 45 minutes. Shake it off, walk around, do something. When I first started trading, when I first started teaching, that Guitar Hero had became popular, and I used to play Guitar Hero a lot in between candles. And I got pretty good, but I could not beat Rain of Blood on level 3. I just couldn't do it. Anyways, the guys that play know what I'm talking about. That's what me and Heidi used to do, was to take turns. We used to wait for the candles to paint and pass the guitar back and forth. Just figure out some way to not stare at the screen and to kill some time so it doesn't force you or make you anxious to get into something. You know these are the conditions. This is it. There's no momentum candles, and this is it. You're looking for these 3 conditions. When the conditions are met, you're looking for consolidation. I see it. Okay, stop hunt starting. I know the stop hunt takes about 30 to 90 minutes, so I'm not going to sit there and stare at every 5-minute candle or every candle that paints. I'm going to give it some time to unfold. Okay? All right, and then you're in the trade. Put your stop on. Wait for the trend run to commence. Don't get nervous or spooked by every little move. Remember, they got to hit the stops. Hit the stops. They're going to come. You'll be in a trade. When he comes back to hit the stops on that first level consolidation within the intraday pattern, you're going to get close to your entry. All right? Okay, so let's talk about moving averages, how they pertain to for our use, for us to understand. You'll find moving averages on everyone's chart. All right? M&W formations, pivots, ADR, TDI. We're gonna talk probably about the averages, pivots, and TDI. I've mentioned ADR a little bit, and it's also in the boot camp segments. Okay, so the moving averages. This is one of the most common things or elements of any system. You'll see them on everybody's chart. Ask any trader what they use, and almost without, beyond the shadow of a doubt, 99.999% of them are going to tell you they got some form of a moving average on their chart. So we're no different. Now, from a market maker's perspective, if everybody uses a moving average, would it make sense that as a dealer I would want to fake to these areas, cross over these areas, or validate these type of signals in order to screw people up? Absolutely. But we can use the averages to our advantage to help us identify levels and to see where we are in the market maker trend cycle and to understand the fake acceleration where the price separates from those. And we start to realize that when the averages get too fanned out, standard deviation rules, it's going to come back. But understand that a collapse back below the mustard or the ketchup will lead to the further decline back to the 50. Understanding if the M is present after 3 levels of rise and so forth. Those things, okay? In fact, I know Kim's going to present, but she uses the ketchup as her guide for her intraday pushes. I'm not going to steal her thunder. She'll discuss that with you guys on Sunday. Okay? For this course, we use exponential. You could use whatever you want. And I know some people added, they pulled in like the 30-minute average. They did some things. Granny was instrumental in doing that, bringing in some extra moving averages. You can have 500 of them on your chart. I don't care. But understand that the main averages, of course I didn't invent this, are the 50 and the 200. They use that on daily charts, Investors Business Daily, some magazines. I can't even think of the name of the magazine right now. I'm choking under the pressure. Those magazines show charts with the 50 and 200 SMA on there, on the dailies, and showing, oh, an institutional signal has fired, the 50 crossed the 200-day moving average, that kind of deal. All right, the stuff I didn't invent, it's just common. So the reason I like the exponential is because, yeah, Business Week, thanks. The reason I like the exponential moving average is because it places more weight on the current price. And I told you that the history of the chart is BS. It's that we're concerned about the last 3 to 5 days. So it would make sense that we would place more weight on what the dealer's doing right now. So for our class and for our purposes, we like 5, 13, 50, 200, 800, which is simply mustard, ketchup, water, mayonnaise, blueberry. Okay? That's how we look at it. So condiments to help us identify that, and the colors coordinated. Someone said we should go to green and do relish, but everyone here has been calling it blueberry, so we're stuck with it now. Okay, 15200 used by most institutions. They appear in every single trading textbook. Any book I've ever picked up says, oh, look at price declining above or below the moving average, or coming back towards. Every book I've ever seen in my 10, 12, 13 years, whatever the hell I've been doing this, every single book has moving averages in it. It talks about, oh, this one's better, manage your trade with the 80 MA. Seen it all, man. But the reason that I picked these is that the 5 and 13, okay, you could do a 5, 15, not much different. It just matches up nicely with TDI and gives pretty good signals. The 13 price seems to like touch it and pull back or close above or below, and it seems to line up pretty good. But remember this, there is no indicator that can replace your ability to identify the pattern and the count. That's why it's hard to black box this, make an EA, all that garbage people have tried. The problem is with that stuff is market conditions change, and only you can identify an M or a W and know where you are in the cycle. Know if it's a safety trade or if it's going to be a straight rise, straight fall. The straightaway trade damages any expert advisor that's coded to take M's and W's above and below the blue box, because the straight rise kills those. That's why this stuff can't be coded. You are the filter. You got to look at this stuff and analyze what the dealer's doing. Identify level 3 head and shoulder trap. Going into consolidation, I expect the dealer for a straight rise. That's the stuff to understand that the human element that a black box can't decipher that stuff. The 200 EMA represents the 50 EMA on the next higher time frame. The next higher time frame for our purposes is the 1 hour chart. You look at the 15 and the 1 hour chart. So if you're looking at the 1 hour chart, the question was asked, how do we poll the 1 hour 50 EMA, the water on the 1 hour chart? How do we make it appear on the 15-minute chart? Okay, so we converted water to mayonnaise, and we polled, so essentially we polled the 1 hour chart, and we said, where's price in relation to its balance line, which is the 50 EMA, the intraday balance. So we pulled that line and brought it over. Okay, so in a way, that was a long explanation. Now, the 800 tells us the position, the relative position of the 50 EMA on the 4 hour chart. So now, if you're staring at a chart and you see the mayonnaise, the blueberries, and the water, and price is trading below that, you don't have to look at the higher time frames. You simply understand price is in a downtrend on all time frames. So any trade taken counter to the market maker cycle, the U.S. reversal, or if he makes a run in Asia, the London reversal, you got to have a take profit at the water or the mayonnaise. You must also use a trailing stop in case the market maker deliberately holds price away from the average. And man, they do that. They go right near the average and won't hit it. That's because there's orders built up there and they know it. So they're just like, I'm going to come within 5 pips of the 200 and I'm not going to touch it. And then they'll go the other way. So if you see the dealer already made his run and you're trading counter, you got to use a tight take profit, especially for your U.S. traders. Because he's going to make the end of the run and go back into the range, and you don't know if he's going to close at the 50% fib, the 32% fib. I'm kidding. You don't know if he's going to go into mid-level consolidation or he's going to go consolidation near the low, 25 pips off. You don't understand where that's going to happen. You don't know until he does it. So I'd hate for you not to use a take profit and tighten your stop and have what was a good winning trade turn into a loser. Okay? And yes, manually close that trade out. All right, so I'm looking at the 15-minute chart. Okay? Here's the 1 hour chart. Okay, the blueberry's not on here, but let's say for argument it's right here. Okay, so I'm polling these numbers, these lines, these averages, and I'm bringing them in. This line, the 50 EMA right there, the 1 hour 50 is mayonnaise right here. Okay? The 4 hour 50 on the 1 hour chart is mayonnaise. It's 4 times higher. It's the 200. So if we brought it in, it would be the blueberry line right here. So now, I don't have to look at this chart, and I can tell you at a glance what the 1 hour is doing, what the 4 hour is doing, and what the daily's doing. These averages don't cross over and fan out in 10 minutes. It takes time for them to develop and to get separation. Separation comes from price action raising higher or price action declining lower. So simply by looking at a 15-minute chart and understanding what it is that I'm looking at when I see an average, most people go, yeah, there's the averages. Okay, yeah, there they are. What do they mean to you? Well, they mean that on average, they're there. That's what people don't understand how to use the indicator. So what I'm telling you is that if you understand when you're looking at a chart, all the things that are supposed to be running through your head, you realize that, no, when I see higher time-framed averages on a 15-minute chart, I'm polling the 1 hour, I'm polling the 4 hour onto my 15-minute chart, and it's telling me that by a quick glance that on those higher time frames, price is trading above. I don't have to look at those charts. I know that I'm in an uptrend on those higher time frames. That's what it's essentially telling you. Okay? Easy stuff, but basic. All right. You walk up to a chart, Forget about price action. You walk up here, you have the 4-hour 50, the 1-hour 50, the 50 itself, the signal lines, the 13, and 5. Immediately, I can tell you that there's the crossover. Price is in a downtrend. Okay? That's it. You just simply look at that and you know, without looking, where you are in the cycle. Okay? And it's kind of cool when you look at this. There's a consolidation. There's the drop. Hit the stops, drop, W formation, back into consolidation. All right? It's in there. All right, so by looking at a 15-minute chart, we can tell where price is trading on the 1-hour and 4-hour charts. Once we do our initial check downs, it is not necessary to look at all those charts. I've seen people that have so many charts on their layout that they can't even see the price. And you're trying to see a behavior that the dealer makes with price. So if you have too many charts open, how the hell are you going to see that? So once you do all the check downs, get rid of all that garbage and just open your 15-minute trading window and make your decisions from there. You should have, after you do your checkdowns, I have a rough idea with the checklist. You know, okay, I looked at, let's just say EU. All right, EU has made 3 levels of drop. All right, it made its move up. Okay, I'm in consolidation now. I'm looking for a safety trade coming out of here. I look on the 1-hour. My count looks pretty good. That's what I think I got. I think I got a peak formation low into consolidation. So if this is the start of the week, it's Tuesday, Wednesday, I'm looking for the dealer to do this. So if this is what my set looks like, now I know, get rid of the 1-hour chart, 4-hour chart, close it, and blow up 4 charts of the pairs that you're looking at. 1, 2, 3, or 4. Okay, if the Asian boxes are blown, cancel them out. Scale it down to 3 or to 2 charts. Now these are the pairs I'm looking for a trade. If these pairs behave the way I expect them to behave, I crush them. If they don't, I take a pass. And I wait for tomorrow. Every day, the market maker will make a new high and a new low. It's up to me to master my behavior and my emotions. Level 1 is identified by a flattening and tightening of the averages. When the averages turn over, okay, after a big separation, the averages will start to flatten back out. Level 2 is identified most of the time by a crossing of the 50 and the 200. Price will break to the upside, causing the crossover, and then making the pullback and bouncing off the average and going up, okay? That is where the 50-50 bounce trade comes in. All right? When the crossover fires, you're usually getting into level 2. And most of the time, when price hits the 50 and bounces, it'll go for at least 50 more pips. All right, let me explain that again. That's a 50-50 bounce trade. Okay, what happens is the levels are running up nice. They cross over. Price has made its run away from that. The crossover is fired. It has not touched. It comes back to the 50 and throws the pattern. Stop hunt, low rise, and this trade will be at least good for 50 pips. A bounce off the first touch to the 50 is good for 50. Okay? Level 2 is identified by the 50 and 200 crossing. This is on a 15-minute chart. You expect it to come back, make a stop hunt, and bounce off the average, and at least go back to the high of level 3. Level 3 is identified by a fanning out of the averages. How do I know I'm in level 3? The averages get huge. Price acceleration, price is out here. And if you're still not sure, it'll start chopping, make a head and shoulders, and then come back in. All right? That's how you read these babies. Okay? I think this is kind of funny. Stop hunt high, drop, consolidate, drop, consolidate, drop, shoulder, head, shoulder, back into consolidation. One more W in case you weren't sure. And then hit the stops high and end the day. Okay, that's a line chart with the averages. As one of the drills that we do a moving average only trade. People curse me out. And we do a TDI only trade. And that stuff is in the boot camps. You guys haven't done it. Absolutely recommend it. It's cool. Okay. What has to happen for the 50-50 bounce trade is that price has to be separated from the 50, and when it comes back and hits the 50 and bounces off, it's good for at least 50. Okay, but if it's the wrong time of day, I meant to say that, needs to be the right, correct time of day. But go homework it. Go look at it. Go look at when, in the bright part of the cycle, when the 50 and 200 cross and price makes its first return to the 50, it usually bounces off. That's by way of the cycle. Check it out. Especially in GBP USD. All right, so this is 2 pins to the Mayo 22 trade. Okay? The dealer fake past the 200. Pins to the mayonnaise. He goes up, consolidates. Comes back down in 1. Check this out. 1, 2, 3 little pushes. Okay? Jim Nicholson said in GU, New York session, 50-50 bounce with 2 legs. Yeah, go have a look. Thanks for pulling that up, Jim. Look, check that out. There's 3 little pushes in the average line, price line, pulls back, second leg W, and on the bigger scheme of things, this is the second leg of a second leg, a multi-session. All right, first level of rise, stutters at the Asian high, yesterday's blue tracer, breaks it, pulls back. Okay, level 2 is formed. Looking to go short? No, not here. Wait for the third level to show itself. We're getting into mid-session. Price is declining. I know this is an M. The dealer hasn't issued 3 pushes intraday. Then he comes back for 1 more push. Now you go short when price collapses below the mustard or the ketchup. And then you trade back into middle of the range or consolidation. All right, so you're looking for 3 pushes intraday. 3 pushes intraday. And if you get 2 and he shows your formation, don't fall for it. You're waiting for 3 levels of rise, 3 pushes of rise. If he doesn't give it and just ends the day in consolidation, you're better for not having taken that trade. There's always tomorrow, my friends. All right? 3 pushes inside the average lines. See it? It's in there. There's the W, right to the mayonnaise. There's a good entry. The price rides open, get acceleration to the top side. You know what's next. Okay? Take everything off your chart and look at the averages. Homework it a little bit and see. Realize price came back, bounced off the 50, continued down for the level, 50 pips. Then it hit the mayonnaise and then rattled around and reversed. Okay? When the 50 and the 200 are close to each other, I want to point that out. Price will have a tendency to rattle around in there. Okay, and try to confuse you. The pattern, the pattern, the pattern. All right, we looked at the M&Ws, but I'm going to break them down really quick. I'm going to go through this fast. You understand what they mean, how they're formed, what's the underlying psychology. We went over that. But what it is simply is a 1, 2, 3 setup. And I didn't invent this stuff, but I got to tell you, I've read every textbook, and before I was taught, I was like, the hell is a 1, 2, 3 setup? How do you trade that? What's the deal? The technically correct entry is at the nadir and the apex, or whatever that someone told me they were, and it's wrong. I'm telling you, it's wrong. Your stop loss has to be too deep. You've missed the shift zone and most of the fun, because usually after the dealer comes here, he'll do this. So now you're in a trade that appears to go sideways. Our entry is somewhere in here for a no drawdown trade. Our entry is here. Technically correct entry is late to the party. Okay? When you guys get in here, don't forget I got in right there. All right? Kidding. Market makers work the low for 30 to 90 minutes up to 2 hours. All right? And we looked at enough of these. That doji close is a good entry because the dealer set the low. You got confirmation, an RSI line. Okay? When the dealer rises back to it, slightly breaks it and closes on a hammer, good confirmation. Here's your shift. Okay, so a lot of this stuff in the textbooks, is, if you understand what you're looking at, is simply a take or a variation of an M or a W. Flags, wedge, pennants, triangles, head and shoulders. All this stuff are takes on traps by the market maker. But I'm telling you that following those rules in the textbooks are a 50-50 proposition at best. They're worthless. You have to understand where price is in relation to the high and to the low of the day to be successful. Okay? Right, I always talk about the head and shoulders. Your job is to identify the pattern and just simply sell on the second shoulder in this example. Waiting for the neckline is too late, man. Okay? Or depending on the day, this could be your M formation. Level 3, safety trade comes in here or in here. Safety trade is off the shoulder, right? Safety trade is off the shoulder. Why, when the safety trade presents the stop hunt, would you come in at the neckline? That's like mid-range. We don't trade mid-range. Mid-range is for suckers. Don't be one. All right? Symmetrical triangles, garbage, garbage. Just want to go over these so you understand to throw these technicals out. The only way that this is a good trade is if this happens to be the high of the day and it reverses off of here. Okay, one of my favorite things I used to say, and I haven't said it in a while, is this. How many times have you heard people talk about these patterns, these wedges and stuff? And let me illustrate what this is so you understand. Higher level longs trapped, lower level shorts trapped. Higher level longs trapped, but not as high as the first trap because they have a certain amount of dollar volume grabbed up. Lower level shorts trapped, but higher than the first level of the trap as to not release the volume. Again, shorts are trapped, longs are trapped. Now they go in and they rattle around, right? Now what has the dealer done in essence? Bring it in, bring it in, bring it in, bring it in, bring it in. A series of traps against the retail traders. Analyze the volume. Look at my book. What do I got? I got 3 trillion short, 1 trillion long. Okay, I'm going to break to the upside. But how many times have you heard this? Oh, when they do these symmetrical triangles, there's a head fake. Really? The dealer's sitting there going, with his head bobbing at the screen. Really? There's a head fake. The head fake, which people don't understand, so they made up some shit. Head fake sounded good. They went with, oh, it's a head fake. It's a stop hunt. Why? Because they're so greedy, they got to break to the wrong side, pick up the pending orders, trigger the stops, and then go the way they were going to go anyway. That's what this stuff is. That's what a head fake is. A head fake is a stop hunt coming out of continuous traps. Good word. Right? They bring it in, analyze their book, see what they got, hit the stops, and rise back out the other side of the triangle. Waste of time. Waste of time to look at these unless you understand the bigger picture, what's going on. Okay? The dealers do bring it in. That's their job. Remember I showed you the intraday cycle where they hit the stops, hit the stops? They make these little patterns. They go like this. They form a little pattern. But what they're doing is, understand, hit the stops, correct. Right? Then they do this again. Hit the stops, tighten it up, bring it in, hit the stops, drop. That's what's going on. That's understanding what this is in the right context is valuable. But trading it as a retail trader is garbage. Okay? Understand. Important. All right, pivots. How to project the high and low and intraday support and resistance and what the possible trading range for tomorrow would be. All right, so to understand how to project the pivots on the chart. Pivot points are based on the open, high, low, close of the daily candle. That's what I said you get from the daily chart. Remember a few slides back. Okay, what color is the daily candle on Euro? Green, red, purple. I don't care. It's either green or it's red. It means that it closed down or closed up. If it closed down, that means I have a red candle. A red candle would indicate that I expect the high to be around M3 and the low to be around M1. If the candle was green today, then I expect tomorrow's low to be M2 to rise to M4. I'm just looking for a rough idea with the box and my projections of where the low or high might come in. So since we understand that a dealer is capped by ADR, he has a limited amount of pips that he can use. We have to understand then how these projections come into play. So let's just say I'm a dealer hanging out, and I get to my desk, and he tells me, I need you to move 100 pips today. And I'm like, I'm perplexed. 100 pips. What would I do with those 100 pips if I was a dealer? Okay, here's what I would do. I would take those 100 pips, and I would allocate them in such a way that I paint the daily candle. Right? The daily candle looks like this, right? So I'm going to change colors for this demonstration. Okay, I want to paint the daily candle with my 100 pips. We know that most daily candles look like this, right? So now here's what I'm going to do. I'm going to come out of consolidation from yesterday at the open. And I'm going to take out of my 100 pip share that the big boys from upstairs allowed me to play with today, I am going to take 25% of those pips. Remember, I was allotted 100 pips. I'm going to take 25 of those pips, and I'm going to come out of consolidation and make a stop hunt to the high side. I am then going to pull back, start my trend run, and form my 3 levels to the low with 75 of my remaining pips. I am then going to pull off of the low 25 more pips and end the day in consolidation and create the close of that candle. That is, for our purposes, how the daily candle is set. When you look at one candle in the daily, I hope to God you're not just going, yeah, it's a candle, looks nice. You understand that consolidation at the open, dealer spiked to the high with 25% of his usable ADR. If it's 200, it would be 50 pips. He then made his level count, or his pushes to the low, may or may not be visible. He then ended the day pulling away and back into consolidation to hit the close. That's what happens over 24 hours inside of a daily candle. Now that we understand that, and we realize that inside of that candle, the damage has been done. Now, we know that candles don't form in a stack. That would be the coolest market in the world to trade, right? They're stacking, just go short. We know that they don't stack. We know that candles overlap. Okay, I don't want to erase all drawings, I want to erase the piece. Okay, so now, the consolidation is here. Tomorrow's candle, the dealer is given his same 100 pip ADR, and he is told, all right, today's no different. Same shit, different day. All right, so what does he do? In a down cycle, he goes into consolidation, maybe shifts the zone up and opens here, consolidates, hits the stops high, drops 1, 2, 3, pulls back, end the day into the range. There's my close. That's my body, my candle. That's what happened. The real body is the open and close, not necessarily the trend run because there's big wicks. So now, since we know candles overlap, we can take these values, the open, high, low, and close, and project them and have ideas of how the dealer allots his pips and where he may make his stop hunts and where he might make the low based on projecting. Pivot points, when used for our context properly, and knowing how to read them the right way now, gives us central pivot point is yellow. We know that 25% of the dealer's allotment is above the central pivot point in a down cycle, and we know that 75% of the dealer's usable allotment is below that. So now, to put this into a pivot point context, the dealer comes out of consolidation at the central. He makes his stop hunt high, drop, level 1, stall, level 2, stall, level 3, pull back, end the day back in consolidation. 1, 2, 3. End the day 25 to 50 pips off of that number into consolidation. I have now spent my 100 pips to the maximum benefit of my branch of the bank. Okay? The exact opposite for an upcycle. If price has been trending up, we know that candles overlap. I can take the low, open, low, high, close of what happened, and I can take these numbers and project them into an allotment for tomorrow. I can take 75% will run trend, 25% will be used for stop hunt. I use the pound. It's a 200 ADR upon average. So I know at the open, I'm going to open at the central. I'm going to make my stop hunt low. 1, 2, 3 to the high. Pull back, end the day here. The difference is in my allotment, my ADR is about 50 pips, which is 25% of my move, will be used for the downside stop hunting. 75%, which is 150 pips, will equate to my run, and then I know that I will close 50 pips off of the high in most pound pairs to go back in the consolidation. So that's my allocation. That's how I use it. Now, understanding this about pivots allows us to project the grid for tomorrow and have a rough idea where those lows and highs will come in and what the run could be. So if today is an M1, M3 day, I project that onto the chart. I'm looking for the dealer to form the high, stop hunt high around M3, and I'm looking at them to terminate around M1. If I get 3 levels around the M1 and then it goes into consolidation, it's a pretty good spot to look for the door. The dealer has met or exceeded the ADR, reasons to look for the door. If you're trying to convert from grabbing 20 pips to going for the full runs, these are the nuances that will make the difference in you finding those spots. Understand no man-made fixed grid indicator can replace what you know about dealer behavior and level count. But this is some guidance for those of you that just don't see it yet. All right, so to sum it up simply, when the dealer comes out 2 to 3, 4 a.m., if he breaks to the high side in vectors, you sell. The dealer breaks to the low side, you buy. Okay? That's an oversimplification, but understand. Okay? It's the same thing. Sell upward stop hunts, buy downward stop hunts around the London Open. And then reanalyze the data for New York when it goes into consolidation and reanalyze where you are for the session. If you've exceeded the ADR, you're looking for W's, or if you exceeded the ADR high, you're looking for M's. If there's 3 levels in there, if the daily candle has been overextended, you know that in order to close that real body, right, think about where the retracement comes from. Terrible drawing, sorry. In order to close off they always close off the wick, right? They have wicks. The candles have wicks. The wicks come from the market maker setting the reversal and going back into consolidation. That's how a candle, in reality, is formed. It's not a fight between the bull and the bears, and the bulls won, and the bears came in and hit the bear in the head and stole the bear's wallet, and the bulls ran away. It's not what's going on. What's going on is that the dealer has a specific set of guidelines that he trades within that I taught you this week, and you know that he makes the reversal and goes back into consolidation to end the cycle, so then the real body close will be off of the low or off of the high. That's where the candle shape comes in, based on the pattern and a deeper understanding of market behavior. And I hope that clears up for you candles and pivots in one swipe. All right? So here's what a pivot grid looks like on the chart. Okay, black ain't going to work. What can we expect now? We expect consolidation in and around the central pivot point, yellow. Let's just say it's a down day. We expect a stop hunt to around M3, an extension to around M1, and a consolidation maybe around S1, about 25 pips apart. If it's an M1, M3 day, I simply take 33.19, subtract it from 31.25, and that gives me my range, and it hasn't changed. I think it's around 130, and I can't do math in front of everybody, even though I should know this number. I've said it 100 times. I forget, and then I get under pressure. I have to subtract in front of y'all. 31.25 by minus 33.19. What is that? Anyone? Pull out an iPhone calculator and tell me. All right. So just understand that when looking at the grid, because there's a dealer cycle, and that when one candle paints red in the U.S. session, if it's been dropping the daily chart, if it's been dropping for a few days, we expect a reversal. So the pivots will be untrue for that cycle. So understand that M3 and M4, which are mid-pivot point ranges, is a possible area for the high, and M2 and M1 are possible areas for a low to be formed. Okay? So if the dealer comes in and M4s you, projected range is down to M2, end the day. That's the right way to use pivots. All right? Subtract M1 from M3 in the example, or M2 from M4, and gives you the range, possible range, okay? Just understand that 1 and 2 are located below the yellow central pivot point. M3 and M4 are possible highs of the day, and they are located above the central pivot point. To give you an idea of how the daily candle forms, okay? What if you get a doji daily candle or a tight candle with no wicks? That's probably a level 3 candle, because think about what level 3 behavior is. Think about, in context of the market maker cycle, about candles now. You get this, you get this, you get this, and the next day you get that. Did the bulls beat the bears? No, the dealers went into consolidation for 24 hours, right, with a possible outside structure to the low, handled the crosses, and hung around and beat up everybody they could beat up, and then we expect the reversal. So now, even though the candle might close red, we know better, so we switch our projection to M2 low, M4 to the high side. Because we know the cycle, we know what this really means now. Okay? We know that the dealer is in consolidation to form the body, that stuff, okay? All right. Some snapshots of M formation right on the M3 line. Okay, boom, boom. Enter here, shift the zone. Okay, and you got, this is a tough ride, but look, 1, 2, and then he pins the M1. Ends the day back in consolidation. Okay, now in context of the daily candle, right? You're coming at a level 3 consolidation. He just spikes M2, goes to M4, and ends the day in sideways consolidation. There weren't a lot of price bursts in there. Can't really see the levels, but he adhered to the pivots that day. Level 3, choppy behavior. Dealer rattles around between M3 and M1 all day. Pretty cool. 24 hours of L3. You heard of the 24 hours of Sebring? There's the 24 hours of level 3. The dealer just chops price, holding the level, working the crosses, not giving you much of a movement. Okay, this is one of those examples where he shifts the zone on you. He starts the day in consolidation at M4, shifts down, grabs those higher level longs and traps them, goes into consolidation, kind of throws an M. This would be a straightaway trade. Throws an M at the M3, head and shoulders type pattern at M1, back in consolidation at M3. The pattern, be loyal to the pattern, not the pair. Outside structure to M2. He held at M4, spiked above, and came back to M4 to end the day. Okay? That's all you got to understand. Is that M2, M4 is a range, M1, M2 possible lows, M3, M4 possible areas of where the dealer will consolidate into high. Okay? So understand this. Pivot points are essentially an ADR grid, and the extremes are representative of the ADR high and low. Since the grid is fixed, pivots don't move, they're fixed. And the trading ranges are not fixed. If you couple the pivot points with ADR, you got some pretty good support and resistance intraday. I haven't said it this class, and I need to say it right now. What is the best support that there is? LOD, low of the day. The low of the day is by far the best support that there is. The best resistance, high of the day, HOD. Why? Because that's the point where the dealer says, not one more pip. That's it. Not another pip. So when he gets to that number and falls away from that number, that is, my friends, the truest and purest form of resistance based on price action that exists. Because if the dealer goes to 6084, forgot what we were using, 6084 or 6184, and does not go another pip higher, then the pass towards 6184, the second pass that doesn't take it out, 6184 acted as resistance. The dealer will fall from that level. Draw a line at 6184, wait for the dealer to come near it. When he fails to break it, there's your resistance for the day, trade away.